there'll be a down cycle. Whether it's going to be as big as I say it's going to be, time will tell. Um, I think the odds are it is going to be a bust, but I can't. I can forecast it, but that doesn't mean it's right.
Yeah, I think that's cool to keep in mind, of course, what you see as likely versus other possible scenarios. And um, I know we've talked about it, of course, in the past, and of course, it's not a very contrarian statement just to like get your financial house in order and just be responsible, generally speaking. But I know you've mentioned that as kind of just a common sense practice that anybody listening can put into play of, of course, not having, you know, high interest debt to your name, paying it off as quickly as you can if you do. Um, just generally speaking, like getting your house in order. I wonder if there's any specific things you would add to that or just recommendations for people generally speaking as we go forward.
Yeah, I first of all, it's control what you can control. You know, we can all talk about a global bust coming, but we can't control a global bust. We can't do anything about that. We can control what we can control, and for example, if I'm and again, it's hard. One of the reasons I've been on X for over a decade is to hopefully they don't get any economic education in school. Most people come out of both high school and college with very little understanding of the economy, and we've been a consumer oriented economy for a long time. So it's and they're teased with all kinds of credit, and so it's you know, and young people want what they want, so it becomes you know buy today and worry about paying for it tomorrow, right? If at all, and you get yourself into a situation where you have a lot of debt, and you know in houses it's worked out because houses appreciated, and you had a mortgage, but you were over time the value of your house went up, and you're paying the mortgage down a little at a time. So that equation worked only because primarily because we had such a great run in housing prices over the last you know 40 years. Um, but that's not always going to be the case. I think the real estate peak this cycle is going to stand for decades. So even housing, don't don't even if you can afford it, I would argue don't get yourself so far in debt because you want that bigger house, or you want what you want. Um, but certainly autos is a depreciating asset, and I'm amazed at what people are doing in terms of you know buying $50,000 cars with 7-year car loans, or um, or $75,000 cars. Um, I would tell people, again, people have to do what they feel comfortable with. But if you can be satisfied with something less and have less debt, just know that what things look like today is not what things will look like 5 years from now. So um, I would just say you know um, live within your means to the greatest extent possible. If you're outside your means already, work on getting your debt down, because the people that are going to have the best chance of dealing with what's coming, I think, in the 2030s, are going to be those that are debt free, that got their financial house in order. And part of that is in the marketplace, the stock market. If you just buy into the buy and hold strategy that's worked so well for the last 40 years, from the mid 1980s when the mantra really came on, that it's time in the market, not timing the market. If you listen to that for the last 40 years, lots of people are millionaires because of that. They just kept in their 401ks and in their investments, just kept putting money into a mutual fund, and they rode it up and down. They just held it. And so we've had some bear markets, and they got nervous during those bear markets, but it always went on to new highs. And look at us today; we're at all-time highs, and a lot of people have made. I know the Dow, so I can quote the Dow. I can't quote the S&P because I can't remember what the number was back in 1982. But at the bottom in 1982, I was running pension money, and I said to buy in August of 1982. The Dow was, I think, 780, $780, and it's now 50,000. So that's what's happened in the last 40 years. Um, so we're not going to see that repeat. In fact, we'll see, much of that begin to reverse. So my point is the mantra that has worked so well for the last 4 decades, from your financial advisors and pretty much anybody in the financial industry, of don't try to time the market. Most people aren't good at that. You're far better off understanding the compounding nature of money and interest, and just keep putting money in dollar cost average or what have you, put it into a fund, and it will grow and grow and grow. It'll have some ups and downs, but the trend will be up. I'm saying here that is not going to be the strategy that will be successful going forward. If you continue that strategy after, let's say the next 6 months, um, you're going to be, if I'm right that you're going to have a bear market of a magnitude of 70 or 80%, you're going to be spending the rest of your time trying to climb back out of that hole. So if, let's say, you have a portfolio that that your money manager um, does better than the market, so the market goes down 70% and your portfolio only goes down 50, it's still going to take you a while to get that 50% back, because to get back to even, you have to double your money, right?
Yeah.
Um, if you go down 70, if you're in an S&P and it goes down 70 or 80%, you're going to have to, it's going to be even harder. So if you can protect, that's one step in that whole process of getting your house in order, is if you can, and you don't have to be perfect, but if you can get out before the bear market, or get out early before the bear market really picks up speed, and just sit out the bear market, you're a huge step ahead. And then on the other side, the very important thing is that coming out of that bear market, coming out of the bust, it will be different leadership. So it certainly won't be buying indexes that will be the most successful, although everything will rise coming out of the bottom. When you print as much money as I'm talking about printing, and you go down 70 or 80%, you could see the S&P triple out of that bottom, or even more out of that bottom. But then it's going to level off and struggle having to face inflation the rest of the cycle. So the leadership of the next cycle, rather than being growth stocks and tech stocks, um, and things that benefited from interest rates going from high double digit to low, it's going to be things that benefit from inflation, which is first and foremost commodities and precious metals. It'll be energy, which is a commodity. It will be industrial companies that are, feeding into what's driving the inflation. So they're, a company like Caterpillar will be sort of, a lot of their business comes from the mining industry, right? So they'll have plenty of business, and so their margins will expand and be able to keep ahead of inflation. But it won't be consumer stocks. The consumer will have been hit hard, because the majority of people aren't going to be doing what I'm talking about right now. So they're going to get hit hard. Their wealth is going to go down. They're going to lose jobs in the bust, and they'll be digging out for several years after the bust. Right? Look at any of our recessions. It doesn't. The stock market may snap back quickly, but the economy doesn't come back that quickly. It may not feel like you're out of a recession the first year out. So they're going to be, the consumer is going to be constrained. Growth stocks, initially you'll do okay because you're down near zero interest rates, and the first year out is, they might go up a little bit, but they're not going to go roaring away. But as rates go up with inflation through the cycle, that really hits growth stocks because they depend on low interest. They depend on rates coming down, not going up. Um, and same thing with utilities, same thing with consumer staples. So the things that will work in the next cycle will be primarily the things that can have pricing power, that can keep them ahead of inflation, keep their earnings ahead of inflation. And the first on that list is really commodities. And I would tell you, as bearish as I've been on energy, on the other side of the bust, energy will be one of the big winners. I'm calling for $500 oil by early 2030s, and that will be coming from, I think, $30 or below in the bust. So you could see where that will be a big wind at your back type trade. So that's a part of getting your financial house in order, is to understand the market enough. You don't have to know it like I know it, but to understand it enough to kind of protect your capital when you need to protect it, and then get into some better areas on the other side of the bust. And then after that, it's really um, you know do the best you can. In other words, probably the biggest thing is, like I said, we've been a shop till you drop society for a long time. Um, if you can, and some people aren't, but and so they're a step ahead. But for the others, if you can kind of discipline yourself to say, maybe material goods and throwaway society is not the best way to prepare for what's coming. Because I can promise you, when we get to the collapse, things you threw out and thought, I don't need this anymore, you're going to wish you had. Then it's going to be a scarcity of things. I would
Yeah.
encourage people, and I'm not trying to scare people. It's still a decade off, I think. And so my point is that there are things you can do to prepare in the next decade to give yourself a fighting chance. But I would just encourage people to maybe read a little bit about the 2030s, 1930s. Read about the Great Depression, and I'm not saying we'll see it exactly like that, because it'll be different than that, but just understanding you can go from roaring 20s where everything looks great and party on, to a point where it's like, wow, in a short time we went from good to really bad.